Good morning, listeners. Welcome to another informative episode of Dollars with Sense. I'm your host, Ela Lange.
And I'm Terence. Good morning. Today's episode is all about understanding your pay stub. Have you ever looked it over and asked yourself, where exactly do my deductions from my gross salary go, leaving me with my net pay of X amount of dollars? Well, we're going to address that question today with a bit of background info on line items everyone sees on their pay slips, like CPP and EI, but don't know a lot about them.
Your pay stub is an essential record of the money you earned and the deductions you paid during a specific period. So why not make it your responsibility to understand your deductions and monitor your pay in the event of a calculation error by your employer so you can catch it and have it fixed right away?
But more importantly, why not learn what those benefits you're paying are all about? You're paying for are all about, when does CPP pay out? How many weeks does EI assist if you lose your job? The federal government offers assistance which you are directly paying for. It's vital you know the basic ins and outs of these programs.
So dig into your last week's mail and pull out your latest salary statement. Follow along with us as we help you better understand your pay stub. I'm Ela Lange, and you're listening to Dollars with Sense. We'll be right back. Welcome back to Understanding Your Pay Stub here on Dollars with Sense. I have to say, the inspiration behind preparing this episode for you this week comes after reading an article written by a fellow colleague of ours, Jared Gertzen at Investors Group, that he posted on his LinkedIn a few weeks ago. I read it, I had a great chuckle, and had to agree with his guess that there are a lot of Canadians out there who don't understand their pay stub and have faith that their employer takes care of all of that.
Well, by law, an employer has to deduct amounts from your employment earnings, such as income tax, contributions to employment insurance, or EI, and contributions to Canadian Pension Plan, or CPP. These deductions mean that the amount on your paycheck will be less than what the total you've earned. Your employer has to withhold and give these amounts directly to the Canada Revenue Agency, or CRA. The good news is you do get credit for having paid these amounts, which are reported on your T4 when you file your annual tax return.
So that's your net pay or take-home pay, which is your gross salary, less all amounts deducted and paid to the CRA on your behalf by your employer. Now let's talk about these deductions. CPP, or the Canadian Pension Plan, is essentially a forced savings plan that all Canadians must take part in. It's intended to supplement everyone's individual retirement savings plans. It also incorporates disability benefits as well as survivor and death benefits.
It began in 1966 under the leadership of Prime Minister Lester B. Pearson. The basic premise is that those currently working fund the pool of money, if you will, for those currently retired. When a Canadian retires or is disabled or dies, then they or their surviving spouse withdraw money from the pool. The basic idea is that a regular Canadian who worked their entire life in Canada should receive, at age 65, roughly 25% in retirement income from what their working annual income was. For example, if a Canadian made an average of $40,000 throughout their working life, then they should receive roughly $10,000 a year in retirement. But because this is a social program, there is a maximum to what a person can withdraw in retirement. Currently, in 2016, the maximum basic CPP benefit at age 65 is $1,092.50 per month, regardless of how much money you made during the working years. But that also means that there is a maximum that a person has to contribute.
Since the program is mandatory, every Canadian who is between 18 to 70 years old and makes over $3,500 a year puts money into the pool. No tax dollars go into this pool. It's only what Canadians put into it. So for 2016, the maximum amount of a Canadian can contribute to the CPP is $5,088. Basically, if you make over $55,000 a year, your CPP contributions max out at about $5,000.88. If you make less than $55,000 a year, how much are you required to contribute? As an employee, you must contribute 4.95% of your gross income, and your employer must be 4.95%. Again, the total contribution cannot exceed $5,088.
If you are self-employed, you must contribute 9.9%. That's 4.95 plus 4.95%, because you are paying both the employer and the employee's portion, which you must submit to CRA every 4 months, or when you're refiling your annual income tax return. As a self-employed person, you can write off 4.95, or half of it, as a tax benefit.
So let's say you make $40,000 gross per year and get paid every 2 weeks. On your pay stub, you get every 2 weeks, your gross would be $1,538. From that bi-weekly amount of $1,538, $76 is taken off to pay your 4.95%, and your employer contributes $76 to CPP on your behalf. When you retire at age 65, assuming you made an average, that same $40,000 a year, you'd receive roughly $10,000 a year or about $833 a month in CPP benefits.
Now, you might be thinking, well, that's not much to live on. And I agree with you, it's not. We're hoping that while explaining the deductions you see going towards CPP every month on your pay stub, you are beginning to understand how important it is to start thinking about how you are going to fund your future self today. Remember to consider CPP retirement benefits as a lovely supplement to your personal retirement plan, not your only source of retirement funds.
If you'd like to know where you are with your CPP contributions to date, you can order a statement of contributions, or view your account online by registering yourself on My Service Canada account, so Google MSCA, which provides convenient and secure access to view and update your employment insurance, Canada Pension Plan, and old age security information online. The amount of your benefits depends on how much and for how long you've contributed to the CPP. And remember, folks, you have to apply to start receiving your benefits at your nearest Canada Services office.
CPP contributors have the option of starting a retirement pension as early as 60 or as late as 70. Which is the right choice? Well, there is no one right answer. The best choice varies with the circumstances of the contributor or yourself, and even then the choice is usually a trade-off. Based strictly on the numbers, it probably makes the most sense to start the retirement pension as early as possible. But if you have questions around CPP retirement benefits or anything else around CPP benefits, feel free to contact us. It is a case-by-case scenario, and the way we can advise it best is if we have a one-on-one conversation. And you can do this by either emailing us at twofinancialgurus@gmail.com. That's the number 2 financialgurus@gmail.com, or by calling us at 778-879-0820. Does that equal gurus 0820? That'd be nice. Anyways, so again, that number is 778-879-0820. There's a lot more around the subject of CPP that we haven't touched on today. So again, Ella and I are happy to address your individual questions.
Thank you, Terence. I think we'll take a quick break here, but when we return, we'll get back to understanding your pay stub by looking at the other deductions like employment insurance and income tax here on Dollars with Sense.
Welcome back. You're with your two financial gurus, Ella and I, and we are discussing the deductions that come off your pay stub every 2 weeks here on Dollars with Cents. We just talked about CPP at length. The next line item you'll see is a contribution to employment insurance, or EI, which, like CPP, is a program administered by the federal government of Canada to provide benefits to insured people who become unemployed, are on maternity or paternity leave, and or are off work because of sickness or disability. This program is financed through premiums paid by both the employer and the employee. The sickness benefit payment under EI is designated as a short-term solution or short-term disability, and to assist qualifying individuals who experience an income interruption due to illness or disability, if it's of a short-term nature.
Here are some figures for 2016. The employee premium rate is set at 1.88%, which means for every $100 you make, you pay EI $1.88. The employer's premium is a little higher and a little more complicated, so we don't want to get into those details, but know that the maximum insurable earnings threshold for 2016 is $50,800.
So if you fall ill or become disabled, forcing you to miss work, either in whole or in part, and if the time off work results in an earning reduction for yourself of more than 40%, you qualify for EI. You have to have worked for the past 52-week period before the date of the claim, or the period since the start of your previous claim, if you have one. You would need to apply for benefits as soon as you stop working, after which the claim is processed through the Human Resources and Skills Development Canada, or the HRSDC, and you are expected to provide a medical certificate confirming the injury or illness and an estimated length of time you will be off work.
All EI benefits, including benefits for sickness, are subject to a 2-week waiting period, and they're payable for a maximum of 15 weeks, and a parental benefits up to a maximum of 35 weeks. Benefits are paid every 2 weeks, so that should give you pretty much an overall view of employment insurance. You can use the Payroll Deductions Online Calculator, it's the PDOC, to calculate payroll deductions for all provinces and territories except Quebec by going to the CRA website. It calculates payroll deductions for the most common pay periods, such as weekly or biweekly, based on exact salary figures. The payroll deduction tables help you calculate the CPP, Canada Pension Plan contributions, employment insurance premiums, and the amount federal, provincial, again except Quebec, and territorial income tax that you have to deduct from amounts you pay each pay period.
Next up is income tax, my favorite, and everybody else's, I'm sure. Another important line item you will see within the deductions from your pay stub. Well, what can I say except that if you make over $11,600 per year, you have to pay federal and provincial income taxes. Every individual has this base amount as an exemption. How much you have to pay is dependent on how much you earn and is regulated by the government by applying the marginal tax rate. The federal marginal tax rate on an income of $45,000 or on the first $45,000 is 15%. After that, the next $45,000 is 20.5%. The maximum amount of federal tax rate is 33%, and that applies to those who are making more than $150,000 per year. And essentially, these are just federal tax rates. The income tax deduction appearing on your pay stub include both federal and provincial taxes and are based on your marginal tax rate as per your income. So, for example, if you're making more than $46,000 per year, you are going to fall under the marginal tax rate of 24.5%, which means the employer will deduct 20.5% of your income to go towards federal taxes. If your income is over $150,000 per year, then 33% of your gross paycheck will go towards federal income tax. Another 12.8% will be going to the BC income tax, equaling the highest possible tax rate in BC, which is 45.8%.
Finally, your employer may deduct additional items from your pay. So check that out. For example, you may choose to participate in your company's pension plan or group insurance plan or RRSP savings plan. Participation in these programs will reduce your net take-home pay if you opt in to contribute or if they are required.
Most larger employers contribute to retirement savings on your behalf. The contribution most often is a matching amount of up to a certain percent. So, for example, I have one client whose company matches up to 3% of his paycheck to go towards his retirement savings. In other words, if the employee contributes $100 towards the plan, the employer would match $100 as long as it's not more than 3% of his income. If you are in this situation, it is a great way to double your retirement savings capabilities and is used by most companies as an incentive to keep the employees at the firm. This is a very simple example, and often there are multiple opportunities to have a company match retirement savings. If you have any questions, again, feel free to contact us either by sending an email to twofinancialgurus@gmail.com or by calling us at 778-879-0820 or check out our Facebook page, Dollars with Sense.
Last but not least, a few more items there you might see on your pay stub, like, for example, annual vacation taken, which means your vacation days taken along with year-to-date totals. And you may see leave taken. So that's any time that's leave in your current pay period that you've taken off for such issues like family illness, along with special leaves like bereavement or for moving, maternity, paternal, pre-placement adoption leave. All of that could be things that you see on pay stubs. Now, when we come back from the break, we'll leave you with our action items and more information around upcoming events that you don't want to miss. You're listening to Dollars with Sense. Welcome back to Dollars with Sense. I'm one of your two financial gurus, Ela Lange, here with my co-host, Terence Vanderwood. Before we get to our action item, we'd like to invite you out to celebrate Canada Day with us. That's on Friday, July 1st, where we'll be with the Vancouver Tumble Bus. You can't miss us. I mean, we're rock stars of the day because so many children love the Tumble Bus, and we'd love to meet you, talk to you one-on-one about the world of family financial planning. We'll be focusing our discussions around children's savings plans like RESPs for educational purposes or explaining participating insurance policy options as additional savings for your children. It's going to be so much fun for your kids and an opportunity for an informative conversation with us. So make it a point to come by. We'll provide more information on our Facebook page, Dollars with Sense, so check us out and like our page if you haven't done so yet.
That's right. Remember, you can listen to our earlier episodes of our shows full of valuable financial advice, or if you prefer, read the transcripts and give us your feedback. Send us your questions to, again, twofinancialgurus@gmail.com, or call us, or book a complimentary appointment to discuss your goals and concerns with no obligations. And if you need a second opinion, we would be happy to provide that as well.
So your action item is easy. Examine your pay stub. Highlight any areas that are not clear about what they're for and give us a call. We'll be happy to walk you through any details. And I'd like to say a special thank you to our Investors Group colleague, Jared Gertzen, for his valuable contribution to today's discussion. Jared helps families in the Maple Ridge, Pitt Meadows area, so you can always find him on Facebook or LinkedIn. In fact, those links appear on your screen now. And thank you to everyone at CKPM 98.7 FM for broadcasting our show this week, and week after week, in fact. And thank you to you, the listeners, for tuning in. Terence and I are wishing you a fantastic week ahead, and may your dollars and cents be with you.